Okay, great. Good morning, everybody. This is Mark Whistler with Wall Street Rockstar and FXVolatility.com. And thanks so much, FX Street. I'm very excited for today's recorded webinar on Fibonacci Pitchforks. And we're also going to add in a little information on volatility as well, which is obviously a very critical point that all traders must be aware of in today's market, given the uncertainty of what could happen in the future for the global economic crisis. With that in mind, again, my name is Mark Whistler, and at no time today is any of our discussion a direct recommendation to buy or sell. Today's webinar is for educational purposes. I hope to actually trade live and in real time by the end of the webinar. However, the account that I will be trading is hypothetical. That is for legal purposes. To reiterate that this is an educational webinar, and if you choose to trade along with me, then you should trade hypothetically in obviously demo accounts only, as this is educational and not an instance to attempt to make money. With that in mind, we'll go ahead and we'll get started. How is everybody today? How's everybody doing in the wake of even more uncertainty in the global economic crisis? Global economic crisis. Boy, are we all getting tired of hearing that. I'll tell you what, I think I'm just about through with it. That's about what I have to say about that. Anyway, today I think we're going to have a great webinar. We're going to discuss Fibonacci Pitchforks, and what we're going to do is we're going to basically take an old indicator, which is basically just a trend analysis tool, and the Pitchfork tool, which we're both going to measure channels while also being able to identify the mean trading range within any given movement, short or both long. And I do by the way, I do have a old Fibonacci Pitchfork report from Trading Markets that I would be happy to send over. That's completed. It's about a year old or so, but I think the information is obviously still relevant as it's a technical report and not a news-based report. So that will give readers or listeners some more information to follow up on after today's webinar. And then, of course, we're also going to cover Fibonacci retracements as well within the Pitchforks. But we're not just going to cover Fibonacci retracements simply on the aspect of being able to time entries both when we're looking for a pullback within the current momentum trend or when we're looking for an actual reversal entry, but we're also going to look at Pitchforks to be able to identify excess volatility. And I think by the end of the webinar, you're going to see that more often than not, because of too many traders acting at the same time with too much of similar information, based on the fact that everybody is trading with the same platform, with the same electronic execution, that we actually are seeing periods of extended volatility even within Fibonacci retracements. And using that information with the Pitchforks should help traders both be able to move with momentum and, of course, be able to potentially spot reversals before they appear. Finally, what we're going to do is we're going to actually add in a little bit of volatility and probability. And the reason for that is because Pitchforks are a channeling technique tool, and anytime that we're looking for channeling in terms of obviously a directional movement, we need to be able to identify when additional trending could ensue or when lateral trading could ensue. And with the volatility probability information, you're going to be able to obviously time when a potential breakout or reversal at a Fibonacci retracement within a Pitchfork might or might not appear, while also being able to identify when lateral trading within that Pitchfork ascending or descending trend could appear as well. And I think what you're also going to see is that more often than not, we're going to be able to readily identify when lateral trading will appear, especially on a major Fibonacci retracement. And Toro, I'm just pulling up a little information on my side right now. And with all of that I've just mentioned, it's quite a mouthful, so we're going to have to move pretty quickly to make sure we get through all of the information today. And I would like to potentially request that just to make sure that we get through all the information today, that perhaps we don't ask too many questions on other indicators, meaning if we start to cover items, obviously like the Fibonacci retracements or volatility and probability, perhaps let's stay away from things like OBV or ADX. I mean, feel free to ask any question because it's important that you do. However, let's not kind of get caught up in the details so we don't get the general information of the webinar today across. So this is an open discussion, so please feel free to ask questions at any time, even keeping in mind what I just mentioned. But and I really hope that everybody here is able to get the most out of it. So if you have any questions or concerns, or if you would like to just give me a hard time, or if you are simply not understanding the concept, please speak up. Okay, with that in mind, how many people here have actually traded with pitchforks before? And who here can tell me what a pitchfork is? Is anybody the super pitchfork trader here? Anybody has anybody made money with pitchforks before? Toro, there's not. I'm gonna turn the chart on in just a moment, if you don't mind. Oh, okay, that's great, John. Yeah, great, Lindeo. That's what you should be able to do with them as well. You should be able to identify tops and bottoms with pitchforks. They are a really good tool, John. Neptune's mates. Da 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 da. Boyke. Dynamic levels they bring along. Great. Okay. Yep, Toro. Absolutely. And one of the questions I would like to ask here is who before we actually jump into exactly why pitchforks do and do not work, can anybody here in maybe 2 or 3 sentences or less quickly type in exactly what a pitchfork is? And we won't get stuck on this for too long, but I'm just curious if there's any ideas or thoughts out there, and I think it's always good to kind of get the audience perception of an indicator before I actually go into it. 2 parallel lines. Okay, great, Toro. Actually, we have 3 total, but you're right, there are 2 on the exterior. And John, exactly, center line, absolutely, yep. Trend line channel, you bet. Geometric number. That everything is a geometric number, almost, kind of. Sort of, perhaps. Median line with deviation on each side. Rod, you are a rock. Let's give Rod the applause that he deserves, because really what he's that is really the crux of what a pitchfork is. And what we have to understand is that I would like to challenge all of the participants in the webinar today to forget everything that you know about technical analysis and forget the information that you think that you know is correct, because the problem with general technical analysis today is that more often than not, the actual information is not incorrect, but has been delivered unfairly, so that the trader attempting to actually use the information is more often than not even aware of the proper I guess underpinnings of the technical indicator that will truly make it successful or not. And with this in mind, I guess an analogy that I might use is that if somebody handed you a pair of pliers and said that these are pliers, but I've actually decided to call them maybe a Whistler Whistler metal prongs. Would you have any idea that those are pliers based on the name? Yes, be reborn in Forex, Boyke. That is, that's. I think maybe I'm going to use that as the subtitle for my upcoming book here, Reborn in Forex. That is absolutely great. I love it. So anyway, as I was just mentioning a few moments ago, if I were to come up with an indicator and I called it, if I actually called the indicator, and we're using pliers as a metaphor or as an analogy, but if I handed you a pair of pliers and I said that these are actually Whistler metal prongs, would you have any idea that they're truly pliers? The reason why I ask you this is because I'm not against. I do believe that that obviously those who develop indicators, and I've kind of been working on some of this stuff myself, should have a recognition for their work. However, the problem is that when the indicator is named solely on ego and disguises the true information underneath, the problem is that as the indicator takes hold across the masses, the issue at hand is the masses don't understand the information that they're seeing in the first place. So to give you an example, yeah, and by the way, Toro, on VWAP, I actually emailed Mod the VWAP code last night, and then there'll be some pretty exciting stuff coming forward with VWAP, and I'm going to just kind of keep that under my what do you say, under my collar, under my hat, under my shirt, under my lid for now, but you'll hear more about that in the next day or two. And what I'm going to do is just put together a really quick one-pager after this webinar and get it to Maud, and I believe she should have the VWAP code up on my page at FX3. And for everybody here, this is actually meta editor code, so you can apply VWAP to your charts. So, which is a huge, massive benefit for retail traders, I think. Okay, so as I was mentioning before, the breakdown in the way that information is perceived is if we just take Bollinger Bands, for example. Who here can tell me exactly what Bollinger Bands are? Auto adjusts to current price moves. Volatility bands. Toro, you are on the money. John Knoll, you are on the money. Elena, you are on the money. You guys are, I just am so impressed. Now, when we say volatility bands, now let's actually take this, because yes, they are volatility bands, but they're also something else. Can anybody here tell me what they also are? What are they specifically? Yeah, I'm aware of that. One moment, and I will. Moving averages. Okay, Swana, you're on the right track, and Larry, you're on the right track too. Yep, Larry, you're on the right track. If you combine everything that we just said, volatility, deviation, and standard deviation, what are you really talking about? Any thoughts on that? And I'm just doing a quick moment of formatting on my side while we chat, and then I'll display the chart. Ranges of price. The Dharma indicator, well, if there was a Dharma indicator, it would be run around in the snow. Dharma is my puppy, by the way, everybody here. Mirrors prices. Okay, you're on the right track, Larry and Boyke. Who here can tell me what the central limit theorem is? Does anybody know what the central limit theorem is? And we're going to try and stay away from a whole bunch of technical mumbo jumbo, but there are a few items that we need to cover. Okay, great. And now we have our chart all set. And I'm about to post the chart here, so bear with me for one moment. Okay, probability of price. I'm assuming the RA is retracement. Is that correct? Upper, lower, and the mid-range. You know, I want to say something. When I first began doing webinars with FX Street, I think it was almost a year ago. Is that correct, Mon? As I asked about volatility and probability, there were really I think just not a lot of information out there, and I think that the market has kind of caught on to, and retail traders have caught on to the fact that they have to understand volatility and probability. And I just am so impressed because the answers that I'm receiving right now from everybody here are just so far and above what I saw a year ago, and I think that the overall market is doing a good job of providing more information on the importance of volatility and probability. And I think what everybody here. Oh, okay, great. Yeah, thanks, Mud. Apparently, I keep fading in out, so I do move around quite a bit, I guess. So. Yeah, let me know if the sound starts to fade at all, or if I need to make any changes to the sound whatsoever. I think that every trader here should definitely, absolutely give themselves a huge pat on the back, and the reason for that is because your ability over the last year to be able to understand and to be able to perceive the importance of volatility and probability, I think in your answers it really shows how much of a more informed trader everybody here is. And I think that if you keep moving forward towards this volatility and probability information through your own conversations with your own friends who are traders or your own groups, you're going to help kind of bring this information forward. And really at the end of the day, by understanding volatility and probability, we're really kind of giving retail traders more of a benefit. And by the way, can everybody hear me okay right now? Because the microphone meter is not moving, so I just want to make sure. Yes, okay, great. Okay, so a moment ago when we talked about what we're really seeing in terms of everything within a Bollinger Band, when we're looking at the median line, the moving average, when we're looking at both the upper and the lower band, and I'm going to show you right here, I'm setting, this is just for the sake of example, but I'm setting some Bollinger Band periods here, and everybody can see my chart. Yeah, in Coco, I will show you, actually that, all of my webinars through, or the bulk of them through April, are all on volatility and probability. So by the end of April, you should be an expert volatility trader, I think. And I will and I'll go over a little bit of that today as we kind of drill into the Pitchfork side too. And right now I'm showing that it's actually 11:25. To make sure that we're on track for time, if somebody here could let me know when we're at about 11:35. Because at 11:35 we'll need to start moving into Fibonacci retracements with the Pitchforks, and then maybe at 11:45 if you could let me know as well, and then we'll actually move into the probability with the Pitchforks and the Fibonacci retracements, just to make sure I don't get stuck on one of the three for too long. Anyway, what I'm going to do here is I'm going to draw some Bollinger Bands with a 3.2. No one after you, pal. I'm going to draw some Bollinger Bands with a 3.2 standard deviation. And here's the thing, when we talk about Bollinger Bands, and again, this is how the public has sort of been misled a little bit. And don't get me wrong, I think John Bollinger, I mean, personally one of my trading idols. His book on Bollinger Bands is amazing, and I think he's actually done some incredible groundbreaking work for traders across the world. I have nothing but respect for him. However, the naming of Bollinger Bands as Bollinger Bands has unfortunately left some items sort of in question for what Bollinger Bands really are, and they're not just bands above and below a moving average. They're truly the measurement of the outliers of a distribution. Does everybody understand that? What I'm saying here is that if we measure a distribution like a Gaussian curve, then we have to be able to measure the ends, the outlying points of that distribution if we want to have any foresight into probability whatsoever. And of course, via descriptive statistics, we always measure distributions through 1, 2, and 3 standard deviations, understanding that one, and I'm going to round the numbers, but one standard deviation is approximately 68% or excuse me, 68% of all of the data should lie within 1 standard deviation of the mean. 95% of all of the data should lie within 2 standard deviations of the mean, and approximately 99.7% of the data should lie within 3 standard deviations of the mean. And let me show you how incredible what I just told you is. I just said that all of the data should lie within, or 99.7% of the data should lie within 3 standard deviations of the mean. So what I'm saying there is that basically those Bollinger Bands that are marked at 3 standard deviations should contain, they should frame all of the trading data, and barely any trading data should exceed those 3 standard deviations, because of course, again, there's a 99.7% probability that all of the data will lie within those 3 standard deviations. Here's the proof of the pudding. If we take a look at the hourly chart, you'll notice that at only very rare moments does the euro-US dollar on the hourly chart, and we can look at any time frame, exceed the 3rd standard deviation. If you were to measure this chart, all of the data within, and to measure whether it's inside or outside of the standard deviations, we know this is a 3.2. We're using 3.2 because there's a slight bit of data loss. If we were to use just a regular 3 standard deviation, we would bring down our probability percentage. So we have to increase the standard deviations by 0.2. I think everybody already understands that. But we can just look at this chart and visually identify that that 99.7%, or probably more like about 95% of all of the data lies within 3 standard deviations of the mean. Does everybody see that? So what we have here is we do not have a chart with one moving average and some lines that go up and down. What we have is a distribution. We have a distribution that moves. And as you can see, if I were to draw another line that actually went all the way up, an arcing line just like this would be the actual curve of the data. And we know that the curve of the data would be much wider in this area than in this area. Why is that? It's because we took out support and we actually increased our volatility range. Does everybody understand that? How far a candle has to be in a band in order for us to determine either continuation or reversal? Coco, back. I think that Coco, you should question for the FBI, because that is the same question asked a different way. I love it. It's brilliant. I'll show you in a few moments how the actual volatility and probability can help you determine that. And it's not how far a candle has to be in a band. Again, this is how the information has been misperceived to this point. But there's just one simple technique that you can use, and you'll understand whether you're going to see a continuation or a reversal. So what I'm going to do is I'm going to leave the volatility bands up here. We had to get through that first because that's kind of the tough part. Now we're going to move directly into pitchforks to obviously stay on track with today's webinar, and then you're going to see in the end how we pull everything together. So bear with me, because for a few moments it might seem like we're moving in 3 different directions, but in the end you'll see everything come together in one place. Okay, so who can give me a quick one-line definition of what a pitchfork is? We've already generally discussed it, a channel with a median line. Are there any other thoughts out there? Okay, great. Pitchforks, for the most part, and I'm just going to use the pitchfork tool here. Pitchforks are for the most part drawn by finding the low of a current range, and then marking the top. In the case of an ascending range, marking the top of a trough, and then marking the bottom of the trough. The median line dissects the trough, and what we have here is we have a inferred, based on trend lines, we have an inferred range of potential deviation based on the channel that has been put in place. So if we looked at the 2 exterior lines by themselves, we would have an instance of channeling. If we actually add in the middle pitchfork, then what we're doing is we're just visually identifying a hard trend line for the mean. So really, at the end of the day, this moving average and the middle of this pitchfork are sort of the same thing, except what we're doing is we're saying on the 50-period moving average, obviously the 50-period moving average is going to take a lot longer to move up into the range, and also as we can note, the pitchfork sort of moving average, and let's think of this as a median. A median trend line. This is a hard word, and this is why little words are so important when we discuss these concepts, because I don't want to call this the median line. Really, what we're trying to identify is the mean or the average, and we know that if the pitchfork was truly the valid and relevant range that the euro-US dollar should be trading in, at least over the next few hours. If in an instance when the euro-US dollar traded to the top pitchfork or to the lower, if this mean trend line holds any statistical weight whatsoever, we will see an instant of mean reversion. And mean reversion obviously would mean that if we traded to the top of the pitchfork, then we would obviously retrace the mean trend line. Now, I'm telling you this because it's not something that happens all the time. We will not always see mean reversion when using pitchforks, but it's just a concept I want you to be aware of right now. Okay, how are we doing on time? 11:32. Okay, great. Now, what we're going to do is we're going to take a peek here a little bit more. And remember, now we have an instance of a distribution showing volatility. And we know that basically when volatility within a pair starts to increase, then the Bollinger Bands, or the volatility bands as we should probably call them, will begin to expand. And we know that based off of descriptive statistics on the laws of the central limit theorem, and the central limit theorem is basically the concept that if we over the entire range of data from the first day the euro started trading until the last day it stops trading, when the world blows up, data is skewed, and that's because time goes on, and the range will continue to change. And something could happen. The US dollar could completely belly up and never come back. That would create an instance of skewed data. However, if we take a small subset, if we take a pair of scissors and cut out a little chunk, like 50 bars, we're going to have either a Poisson distribution or a normal Gaussian distribution. It really doesn't matter which, but we can measure the standard deviations with the same concept. The reason why the data will not always be skewed within a small data subset of the larger time frame of all of the market data is because the mean moves. And because the mean moves, it means that was horrible grammar. Because we have an instance of a moving mean, what we're saying is that basically if the euro-US dollar were to continue up forever, the mean would move up as well. And eventually a pullback is going to retrace the mean. So what we have is, because of the central limit theorem, markets will always, 100% of the time, always retrace the mean. The question is when, and how long will they stay away from the mean? And some of that depends on what time frame you're looking at. On a 1-minute chart, the euro-US dollar will always retrace the mean quicker than a daily chart. And if I need to explain that in detail, let me know, but I need to make sure everybody understands that. This is an instance of understanding mean regression trading and time. And then we're gonna drop this into the pitchforks. We're gonna add the Fibonacci retracements, and you're going to be super rockstar traders. Okay. So we just visually, we know that basically on the daily chart, obviously if we look back from July of 2008 all the way through December, the euro US dollar, and I'm going to, don't worry about the candle bars here. I just want to make sure that you can see the actual. Okay, Coco. Notice, okay, so the moving average here is a mean. Even the title moving average is incorrect and has screwed up traders. It's not incorrect, but it just wasn't the right choice of words from the start. Moving average should have been called a mobile mean. And I think that the reason for that is because a mobile mean obviously means that it's moving, and even though those two words mean the same thing, and I know this is going to sound like very fickle semantics, but it's very important that the public understand what they're seeing. And then when I say mobile, we know that obviously it's on the move, and I think that the word mobile just has a little bit more weight to it. But then when we use the word mean, I think when most people hear the word mean, they identify mean with statistics. When they hear average, they just basically think half. And so what we have here is just a slight matter of semantics, which truly change the perception of an indicator. Anyway, our mobile mean here is a 50-period mobile mean. Our mobile mean is based off of 50 periods. Did I say that forwards and backwards? And I know it sounds like a simple concept. Everybody knows what a moving average is, but I want you to think differently. I want you to breathe differently, to look at markets differently, and to just let go of everything you know, because if you do and rebuild that information with day one from truth, you're going to be a better trader moving with institutional order flow. So we know that our mobile mean, our 50-period mobile mean here on a daily chart, once the euro US dollar dropped below support and fell below the mobile mean of the 50 period, it obviously had a torrid downward run, and it took an incredible amount of strength to bring that back over the mean. What happened here, as you can see, is we basically took out support and we tagged the third standard deviation. We traded back to the mobile mean, and then we traded all the way out to the third standard deviation outlier again. So what we have to understand is that distributions are not stagnant. They move. And so as the euro US dollar was moving, the third standard deviation was moving because the entire distribution was moving. The mobile mean was moving. Well, what that means is that eventually, because the mobile mean is moving too, we're always, 100% of the time, always going to retrace the mean eventually. It's absolutely guaranteed. The question is, how long can a currency, stock, anything stay on one side of the mean or the other? But eventually it's going to retrace it. Again, the longer the time frame, the greater the probability that the currency pair can stay on one side of the mobile mean. And I'll validate this with the 1-minute chart. Look at the 1-minute chart. And even if we go all the way back, just to make sure that there are no questions here whatsoever, even if we go all the way back, it's going to take me forever to get back there, so I'm not going to go back all the way to December so you can see. But we simply can just validate it on a visual basis. We know, because of the shorter time frame, that we will always retrace the mean. So Boyke, you mean as far as the mobile mean and the measurement of standard deviations? In what I just said, in other words, as far as the moving average and the Bollinger Band settings. But we cannot call them by those names anymore, because that's not what they are, by the way. Yes, absolutely. And now think about it. Why would the settings change? Because if you're measuring 50 periods of data, you're measuring 50 periods of data. And 3 standard deviations are 3 standard deviations. And if you look at a 1-minute chart, we have the same concept that all of the data lies within 3 standard deviations of the mean is validated equally. Okay, So now I need to move into continue with the pitchforks and the Fibonacci retracement, so we get everything together here. I just need to make sure everybody understands basically what we're looking at here. We're looking at a moving distribution. We're looking at a mobile mean, and we're looking at our outliers of the distribution's curve as measured by the volatility bands. Okay. Great. Yeah, thank you for the time there, Boyke. You're
Hurry up!
Star. Hurry up! I love these sounds there, Chris. Okay, great. So now what we're going to do is we're going to look at those pitchforks again. And everybody remembers on the hourly chart, I drew a pitchfork simply here, based on our low from the low of the relevant range to the high of the relevant trough to the low of the relevant trough. Now, I'm going to pull up a report here, and I'll see if I can get this to trading markets. I mean to FX Street. I need to just check with trading markets to make sure it's cool if I send it over, Maud. But given that this report is a year over or a year old, I don't think it should be an issue. But this actual report was written. I wrote it last year. And here's what I want to tell you. Markets change. And Fibonacci pitchforks alone by themselves don't work as well today as they did a year ago. And who can tell me why that is? They do work spectacular, but we have to use volatility and probability with them today where we didn't need to do so last year. Yeah, Boyke, I will try and get this report over to Maud today. Okay, the problem is that anytime that you have trend lines, and let's just go back and look at let's look at our chart here. Anytime you have trend lines, and this is actually probably one of the only concepts in the market that has been named correctly. When you have a trend line, what is the trend line indicating? You're going to shoot me when I tell you the answer here. Trend lines indicate trending. Okay, so they're probably one of the only words that we can take for truth, or excuse me, trend lines are one of the only words that we can accurately take as truth. The issue is what are we not seeing in today's market? Are a genius. Elena and Lindale, you are too. So the problem is that when we are not seeing significant trending like we were a year ago or 2 years ago, what does that mean? It means that traditional stock trending indicators stand a greater probability of failing than they did 1 or 2 years ago. And we have to be aware of this. And when we use things like channels and hard trend lines in today's market, we have to be abundantly aware that volatility could cause the technical indicator to fail. As long as we understand that that is the true paradigm that exists today, then we simply overcome it by understanding it. So when we look at the euro-US dollar here, now we're looking at, let's take what we have here so far. We have a relevant range based on the 30-minute chart here, and we'll look at the hourly chart in a moment. We have a relevant range indicating an instance of potential trending. Does everybody see that? We have an upward sloping moving average, or excuse me, an upward sloping mobile mean. We know that the distribution has started to turn up. Does everybody see that? We also know that eventually all things retrace the mean. So eventually the euro-US dollar is going to attack this mobile mean. The question is, will it do so with the mobile mean here, or will it do so when the mobile mean is higher? What we know is this also, is that in our relevant range, if the Euro-US dollar were to take out Pitchfork support, and we could actually put out just another outlier lower Pitchfork looking at just ascending support of the relevant range, what would happen? The implied trend from the Pitchfork would be violated, and it would indicate an instance of mean reversion. And if we revert through the mean, there is significant probability that we could actually see a slide to the outside, to the other side of the distribution. Does everybody understand that? Okay, now we're gonna pile on some even more cool stuff, and we have about 8 minutes to do it. Is that correct, Maud? So what I'm really trying to get at here is that if you understand the information that you're looking at, if you understand that what you're looking at is a measurement of distribution that also tracks volatility, expansion, and contraction, if you're looking at the outlier lines show you when the distribution gets bigger and smaller. If you understand that what you're truly identifying here is the total probability capacity of a distribution, then you've already started to put the odds in your favor. Most people just think these are Bollinger Bands, and they don't know what the hell they are. And I beg you to please reshape the way that you think about every indicator that you know about. In our hard trending line here, in the channel that we've drawn, which is a pitchfork, with our mean trend line and then our outlier mean trend lines, we have a Boyke, you have no idea what's coming. And a lot of thought went into the name of it to make sure it was named correctly as well. So I hate to say it, but I gave way to a little ego too. I did put my name in there. I feel like kind of a jerk for doing it, but I decided I had to. Anyway, okay, so now we know that we have our pitchforks here. Now, if we go back to, and I'm just going to pull up the old report here, and let me know if you can see my screen okay. And I'm going to minimize this just a little bit so you can see it. So, you know, my question is, how can the retail trader ever expect to make money when they don't even understand what they're looking at? It just drives me bonkers. It keeps me up at night. Okay. So we know that basically when we draw a pitchfork in an ascending range, we can draw pitchforks in a few different ways. We can find lower connecting points, or we can find a low to dissect a larger trough or rally. So I want to let you know that I'm not going to get into the intricacies of pitchforks because they're an art in themselves, and really for the most part they're pretty simple. You just need to work with them, and once I get this report to you, you can kind of figure it out on your own. I don't want to waste time on it right now because we have more important fish to fry. So we also know that basically when we look at pitchforks, we know that the lower trend line is and the upper trend line is really a hard measurement of relative range trending. If the lower trend line is breached, then we know that that the instance or the occurrence of market mentality within that relevant range has shifted, and we should be looking for some other type of movement. Then, obviously, we know that using our pitchforks, again, on that same concept of relevant range trending, if the trending is truly going to ensue in an abruptly, I guess, what is the word I'm looking for? In a highly probable trend continuation situation, in a descending trend, our highest or one of our greatest probability points of entry is obviously short on the top pitchfork. In an ascending trend, did I just say descending or ascending? Oh, I said descending. In an ascending trend, in the opposite situation, again, remember, I'll just backtrack on the descending situation. Obviously, our point of a high probability short entry is based on the upper pitchfork. What you have to remember, though, is that trend lines are constantly being failed in today's market. We're seeing additional volatility outside of trend lines and then trend line continuations. So if you're aware of that and you're looking for volatility above and beyond the trend line, and you don't take a position before the trend line, but usually looking for a little volatility after it, then your patience alone is putting probability back on your side. What's more, when we find a situation where we're able to identify more than one pitchfork, those descending resistance or ascending support trend lines on the upper in the case of declining market and lower in the case of ascending market, when we find an entry which basically we have 2 points or 3 points of pitchforks that come together, we're adding even more probability on our side. And of course we know that an occurrence of moving through the middle line is obviously the distribution in the hard trend shifting as well. And so we would likely want to take profits on the lower end of the pitchfork were it to hit it. Yeah, Coco, again, I'm going to try and get that to mod. Today I have to check with, I just have to make sure it's cool with trading markets. So, okay, so again, right here you can see what I've done is basically just said ideal entry would be just below the 61.8% retracement. Here's what we're going to do. We're going to take and we're going to drop in a Fibonacci retracement right in the most recent relative move. And what you're going to find is that pretty often you're going to see the actual trend, like the 61.8 retracement, the 50% retracement, and the 38.2% retracement. You're going to see those retracements actually tag critical descending resistance or ascending support lines. And you guys, we have to wrap up here pretty quickly. Where you're going to see the Fibonacci marks actually tag. Let me blow this up so it's a little bit bigger so everybody can see it here. But time just flies. I'll tell you, I think our webinars really maybe need to be like an hour and a half. There's not enough time to cover the information so quickly. So everybody can see that basically what we have here is we've identified an entry point ahead of time based on one, a Fibonacci retracement, understanding that in today's market there is excess volatility and that more than likely we're going to see a blip above the 61.8 retracement, likely to the 66 or 68% retracement before seeing the trend stall or seeing the trend revert back to its downward direction. And we also know that there's trend line resistance as well. But we know that today's market, there's always an extended blip of volatility. So we're going to take our position likely right up above. Well, here's what's so great. Now if I were to take and drop in Fibonacci retracement, I'm going to have to do this in about 1 minute or less. Now keep in mind we have our distribution showing us volatility and probability. We have our relevant range, hard trend lines. And now, if we were to put in a Fibonacci retracement, and some people might draw their Fibonacci from down here. Let's look at what's happening here. Now that we have our Fibonacci in place, it kind of, I guess, sort of depends on which you prefer. But we'll just mark it from the relevant. If we look at what's happening now, and let me blow everything up here, and this will be the final point that I'll make. We know that volatility is expanding. Does everybody see this? Volatility is expanding. That means the probability of trend continuation is high. If volatility is contracting, lateral trading will ensue. If volatility is expanding, trending could ensue. We also know that we're trading right at the mean of the trend range. And if we look at what's happening here, we know that that we start to see the 50% retracement and even the 61 point right at about our lower trend line here. What's more is we're going to see our mobile mean support as well. And as the mobile mean starts to pull itself up closer to descending support of the relevant range, we know that if the euro-US dollar takes out one of these critical Fibonacci retracements, or excuse me, understanding that there's going to be a little period of volatility on each side because of today's market. But if we were, yep, you guys, I got to go. But basically, if we were going to take out like one spot, 32472, this is a huge reversal. Not only have we had an instance of mean reversion, we have violated the relevant range and our critical Fibonacci retracements. And also, if we start to decline, the trend line support, along with Fibonacci's and the mean of our relevant range, are great trend continuation re-entry points for a long trade. I hope everybody's got all that, and I need to go. So I just want to thank everybody so much for all of your time. It was a lot of information to cover today, so please take some time to think about it and digest everything. And I hope to see everybody next week. Thank you so much, and please have a wonderful, wonderful weekend.